The last week of January has been very volatile for your position, with even some losses. Stock markets and crypto could be very hard to understand. What is causing the up and down move? Especially nowadays, it is really good to know the basics of economic principle. Know what you do. And don't let misguide you because someone is telling you so. In this video, we will explain what is causing this down move in the stock market and explain several economic factors what you should know as an investor. Eager to learn more? Well, stay tuned. Welcome to the Ecocation channel, where we keep you informed of all major politics and economic subjects worldwide. Don't forget to like and subscribe to our channel and press the bell icon to never miss an update. The first thing we have to do is take a step back and think about how rare 2021 was. After a year of fear, lockdowns, staying at home, and businesses forced to close their doors, 2021 saw the advent of safe and vaccines and renewed customer confidence. Let's review some of the most important records broken during last year. Of course, the most important one is inflation. Since the Great Financial Recession in 2008-2009, inflation has been really low. But now we see inflation peaking within the United States, 7%, which hasn't been reached since 1982. This is caused by the fact that producers were scaling back their production during the lockdowns, and as soon as customers were optimistic, they began buying again. If demand is more than supply, prices will increase, and this is causing a rise in inflation. Another record was set by the real estate industry. The home prices started to jump in the early summer of 2021 for a 19.7% year-to-year increase. For example, in July 2020, you could buy a home for $300,000, which increased a year later to $359,100. The expectations are that the house prices will increase for the coming years. Besides, inflation in the real estate market, cryptocurrencies were also very popular. In November of 2021, the total value of cryptocurrencies just touched $3 trillion. But also, the stock market did quite well. In 2021, we saw record highs in the U.S. stock market. The increase in the stock market could partially be explained due to the rise in inflation, but also corporate earnings saw a boost from the pent-up consumer demand that was unleashed in 2021. Actually, if you think logically, it seems strange that we saw these records in 2021. Because we still had to concur with COVID-19 pandemic. Looking back to the past, every crisis we faced, there was a downturn in the economy. For example, the financial crisis in 2008-2009 or the dot-com bubble in the end of the 90s. How is this time different? In order to understand it, we have to explain some economic background. The hard part of investing in the stock market or cryptocurrencies is that there is no clean equation that could tell us how prices will behave. We can't simply say if this goes up, the price will go down. There is a lot of market sentiment that we could not explain, and this is what we mainly saw in 2021. But there are some factors that could explain the behavior of the prices of the stock market. Let's start with inflation. Historically, low inflation had a strong inverse correlation with valuations. Low inflation drives higher multiples and vice versa. This means that investors prefer low inflation because low inflation means low interest rates, and there is a greater opportunity for high real earnings growth. People tend to borrow more in a low inflation environment in order to increase their wealth. When inflation is high, interest rates will be higher and borrowing money will be more expensive. Thus, borrowing and investing is less attractive in a high inflation environment. Another important factor is economic strength of market and peers. Company stocks tend to track with the market and with their sector or industry peers. So, in general, if the market and the company peers are doing well, the company will grow as well, and the other way around. Besides, many investors believe in momentum of a stock. That is, if the stock performs well today, it is likely that it will perform good tomorrow. Success breeds success. Liquidity in the market does also have an impact of how the stock market will behave. More liquidity in the market makes it easier and more attractive to invest. Let's take a look at an example. A stock of large cap is highly liquid and more attractive to invest in compared to a small cap stock. Because it is easier to transact when there is more liquidity, you can easily close your position. And of course, news also has an impact on the market, but it's hard to predict how the market will react to news or unexpected developments inside a company, industry, or the global economy. Of course, it influences investor sentiment, but it is really hard to measure. Even many economists have tried to. But one important thing investors forget is that most of the news is already priced in the market. So for example, if you read that investors expect that the earnings of Apple will triple in the nearest future, the news is already incorporated in the stock price. So acting on relatively late news diminishes the investor's return. But how is this time different? Why didn't we see a downturn of the market in 2021? Well, to begin with, the government learned from the financial crisis in 2008/2009, where they started with quantitative easing, thus providing liquidity in the market in order to support the economy. That meant that the economy was able to run as before the COVID-19 pandemic due to the liquidity in the market. Besides more than enough liquidity in the market to support the economy, low interest rates also contributed to the fact that we did not see a downturn in the stock market. It is more attractive to invest in the stock market or cryptocurrencies when interest rates are low. Because if you invest, for example, in government bonds, you will earn less return compared to the stock market. On top of that, individuals had a lot of savings during the lockdowns, and what could they possibly do with all these savings? Yes, invest their savings. And that is exactly what happened. This flood of easy money also contributed to the rapid rise in prices of financial assets like stocks, bonds, homes, and cryptocurrencies, but also commodities like energy and food. As the worst economic ravages of the pandemic appeared to be waning, at least for now, the Fed is pushing for higher interest rate levels. Besides, the Fed is also beginning to withdraw some of the other forms of support that have kept the stock markets alive since it intervened to save the financial markets in early 2020. Of course, this could be a good thing if the purpose is to beat inflation, if it has no consequences for the economic recovery. But removing this support also inevitably cools the market as investors move money around, looking for assets that perform better when the interest rates are high. What happens next comes from an established playbook. As a former chairman of the Fed, William McChesney said, "The central bank finds itself acting as the adult in the room, who has ordered the punch bowl removed just when the party was really warming up." The mood of the market shifted on the 5th of January when the Fed released their minutes of their December policymaking meeting, revealing that they were on the verge of embracing a much tighter monetary policy. Just a week later, data revealed that inflation hit its highest point since 1982, at 7%. If you take these two into account, the Fed has no other option to react and combat inflation and rising prices. As a result, financial assets, like stocks and cryptocurrencies, began to fall. Financial markets now expect that the Fed will raise its key interest rates at least 4 times this year and to start shrinking its balance sheet as soon as this spring. The Fed has already reduced the volume of bond buying already. What we currently see in the market is that the technology sector is one of the worst performing stocks. One reason for this is that the low interest rates amplify the value of the expected future earnings of growth-oriented companies. If interest rates rise, like we see now, this calculus changes abruptly. On the other hand, we see that financial services, energy, and consumer staples are doing well in the beginning of 2022. This is because these sectors are not as much affected by higher interest rates. After all, people have to buy their necessity of life. What are your thoughts about the stock market at this point? Will the stock market regain its value, or will it lose more of its value? Does the Fed do good with rising its key policy rates to combat inflation? What kind of effect do you think it will have on the economy overall? Will this result in a recession? Let us know in the comments section below. For more interested topics of worldwide politics and economic subjects, like, subscribe, and put your notifications